Ever wonder how the super-rich seem to live lavish lifestyles, buying yachts, mansions, and private jets all while paying surprisingly little in taxes? It's not always about shady offshore accounts or illegal schemes. In fact, one of their biggest secrets is a perfectly legal strategy, and it has to do with something you might even own: stocks. Today, we're diving deep into the fascinating world of borrow, die, the wealth-building, tax-avoiding strategy of the old. So, let's set the stage. Imagine you're a successful founder of a tech company. Your net worth is in the billions, but it's almost all tied up in company stock. You want to buy a $10 million beach house. Now, your first thought might be to sell $10 million worth of your stock. Makes sense, right? Well, for the average person, yes, but for the wealthy, that's a huge mistake. Why? The answer is capital gains tax. The moment you sell an asset-light stock that has increased in value, you have to pay taxes on the profit. If you bought the stock for $1 million and sold it for $10 million, that's a $9 million profit. Depending on where you live and how long you've held the stock, you could be looking at a tax bill of over 20%. That's nearly $2 million gone. Just like that. Money you could have used for, well, anything else. The wealthy hate paying taxes. They don't have to, so they found a better way. Instead of selling, they borrow. This is the core of the strategy. They go to a private bank or a wealth management firm and say, I want a loan, and I'll use my stock portfolio as collateral. Collateral is just something of value you pledge to the lender to guarantee you LL pay back the loan. If you don't pay, they can take your asset. It's the same principle as getting a mortgage on a house. Now, why would a bank do this? Because it's an incredibly safe bet for them. A portfolio worth hundreds of millions or even billions of dollars is fantastic collateral. The banks know the borrower is good for the money, and because the risk is so low for the lender, they offer these wealthy clients incredibly low interest rates, sometimes as low as 1 or 2%. Think about that. You can borrow millions of dollars and pay less interest than you would on a standard car loan. This is what we call a securities-based loan or a portfolio line of credit. So, our tech founder takes out a $10 million loan against their stock portfolio. What happens next? First, they get the cash tax-free. That's the crucial part. A loan is not considered income by the IRS. It's debt, so no capital gains tax is triggered. Our founder gets their $10 million and buys that beautiful beach house without giving a single cent to the taxman in the process. They've successfully accessed the value of their assets without selling them. Meanwhile, their original stock portfolio, which is still sitting untouched, continues to grow in value. Hopefully, the stock market does what it usually does over the long term and goes up. Let's say their portfolio grows by 7 or 8% that year. They're only paying 1 or 2% in interest on their loan. This means their wealth is still growing faster than their debt. The gap between what they have and what they owe is actually getting wider. They're literally making money on the money they borrowed. This is the power of leverage. Now, you might be thinking, okay, but a loan is still a loan. Don't they have to pay it back eventually? And you're right, but this is where the strategy gets even more interesting and moves into the die part of buy, borrow, die. For the ultra-wealthy, the plan is often to never pay back the principal of these loans during their lifetime. They just pay the small amount of interest each year, which is easily covered by more borrowing or other small income streams. They can live off these loans for decades. When they pass away, something remarkable happens in the U.S. tax code. It's called the step-up in basis. When you inherit an asset, like a stock portfolio, its cost basis for tax purposes gets stepped up to its fair market value on the date of death. Let's go back to our founder. Remember, they originally bought their stock for $1 million. Let's say by the time they pass away, it's worth $100 million. Their heirs inherit that $100 million portfolio. Thanks to the step-up in basis, it's as if they bought the stock for $100 million that very day. So, what do the heirs do? They can immediately sell a portion of the stock, say, the $10 million needed to repay that old loan for the beach house. And because of the stepped-up basis, the capital gain is zero. 100 million sale price minus the new 100 million cost basis equals zero profit. So, zero capital gains tax is due. The loan is paid off, and the massive capital gain that was accumulated over the founder's entire lifetime is legally and permanently wiped away from a tax perspective. The family gets to keep the vast majority of the wealth, and the cycle can begin all over again for the next generation. So, to recap, buy assets that appreciate, borrow against them at low interest rates to fund your lifestyle tax-free. Then, when you die, your heirs get a step-up in basis, allowing them to sell the assets and pay off the loans without triggering capital gains taxes. It is a powerful cycle that allows wealth to be preserved and passed down through generations with minimal tax friction. Of course, this strategy isn't without risks. The biggest one is a stock market crash. If the value of your collateral, your stock portfolio drops significantly, the bank might issue a margin call. This means they demand you either add more cash or securities to your account, or they'll start selling your stocks at a loss to cover the loan. This can be devastating, forcing you to sell at the worst possible time and locking in huge losses. This is why this strategy is typically reserved for the extremely wealthy who have highly diversified portfolios and can easily withstand market volatility. They're not borrowing against every last penny they have. So, is this fair? That's a debate for politicians and economists. Proponents argue that it encourages long-term investment and that the wealth is eventually taxed in other ways, like through estate taxes. Although there are ways to minimize those too. Critics argue it as a massive loophole that allows the richest members of society to avoid paying their fair share, widening the wealth gap. But regardless of where you stand, understanding how this works is key to understanding modern wealth. It is a powerful illustration of how the financial system is set up to benefit those who have capital. It's not just about earning a high income, it is about how you structure your assets to make them work for you in the most tax-efficient way possible. So next time you read about a billionaire buying a super yacht, remember, they probably didn't sell their stock to do it. They likely just called their private banker. Thanks so much for watching. If you found this breakdown insightful, be sure to hit that like button and subscribe for more deep dives into the world of finance. See you in the next video.